Okay, let's unpack this. Today, we're diving deep into Quadient's recent performance, looking at their Q1 2025 earnings call.
That's right. We're aiming to get clarity on what exactly went down, what the company's saying about it, and what they see for the rest of the year.
So the big headline was a revenue decline in Q1. Is that the main story here?
Well, yes and no. Revenue was down, but importantly, management actually flagged this was coming. They basically said Q1 would be the low point.
Okay. So it wasn't a surprise internally.
Not really, no. They expected things to pick up through the year, especially in the second half, and crucially, they reiterated their full-year guidance.
Which signals confidence, right? That this Q1 dip was planned for.
Exactly. Confidence that they're still on track for their annual targets.
Okay, so let's get specific. What were the Q1 numbers?
Revenue came in at $258 million.
And compared to last year?
That was a reported decline of 1.1%. Organically, so stripping out currency and M&A, it was down 2.5%.
Right. And what did they pinpoint as the reasons for that organic dip?
Two main things. First, this expected low point in the mail business renewal cycle. Think of it like equipment leases.
Like a 5-year cycle kind of thing.
Precisely. So fewer contracts happen to be coming up for renewal in this specific quarter. And second, the macroeconomic climate, particularly in the U.S., added pressure, causing some delays.
So it wasn't customers bailing, just fewer deals hitting the pipeline right now.
That's the narrative, yes. Fewer opportunities presenting themselves because of that cycle timing, amplified a bit by the economy. It's linked to lower placements 5 years back.
Got it. But wasn't all bad news, was it? I saw some positive signs, especially around subscriptions.
Absolutely. That's the key counterpoint. While the overall top line dipped slightly, the recurring revenue parts looked really healthy.
Like in digital and local.
Yes. Strong double-digit growth in subscription-related revenue for both digital and local solutions. That shows the underlying strength in their growth engines.
And profitability. How did that hold up with revenue down?
Surprisingly well, actually. Current EBIT, that's, operating profit, it grew organically year over year.
Really?
Driven by better EBITDA margins, that's the cash flow measure across all three solutions. Even mail saw a slight improvement, helped by integration benefits, apparently.
Okay, interesting. So it expected revenue dip, but profit heading the right way and strength underneath. Let's zoom in on those segments then, starting with digital.
Digital had a, frankly, very strong quarter. Organic growth was 7.2%.
Nice. And the total revenue?
Hit $67 million, up from $63 million last year.
And you mentioned subscriptions earlier. How did that part do within digital?
Even better. Subscription revenue was up 11.1%. Real acceleration there.
Wow. Where did that growth come from?
Pretty broad-based, actually. North America and the UK were particularly strong performers.
And the drivers?
They highlighted two things. Good cross-selling, so selling digital into their mail customer base, and also strong new customer acquisition, especially enterprise clients.
And that feeds into their recurring revenue metric, the ARR.
Exactly. Digital ARR, annual recurring revenue, grew 9.6% to $237 million. That's a really positive indicator for future stability and growth.
Makes sense. Beyond the core numbers, any strategic stuff happening in digital? Partnerships, tech shifts?
Yeah, they mentioned a new strategic partnership focused on cloud payments. The goal is a unified B2B payment platform globally.
Okay.
And they continue pushing towards SaaS, software as a service. SaaS customers are now almost 85% of the digital base.
So the transition is well underway.
Definitely. And what's really interesting is the external recognition they're getting. They mention analyst reports like Gartner and Forrester, naming them leaders in financial automation.
Like APR, accounts payable, accounts receivable.
Precisely. For years, they were known more for CCM and CXM customer communications and experience. Being recognized as a leader now in APR shows they've successfully broadened their scope.
So moving beyond comms into the finance department's tools.
Exactly. They're positioning themselves as a key player for the office of the CFO now, which ties neatly into
the Cerenzia acquisition. Yeah, let's talk about that. That sounds like a big move within digital.
It really does seem like a strategic game changer, especially for Europe and France in particular. Cerenzia is an e-invoicing platform.
Right. And the key thing is it's a registered PDP. What is that exactly?
A PDP is a partner dematerialization platform. Basically, it's a government-certified intermediary in France for processing electronic invoices.
Ah, okay. And why is that so important?
Because France is bringing in mandatory B2B e-invoicing starting September 2026 for large companies. Being an officially registered PDP gives you a license to operate in that mandatory market. Cerenzia is one of the first to get that status.
So it's a regulatory key to unlock that market. And Cerenzia already has scale, something like 200 million invoices a year.
Yeah, significant volume. Plus, existing relationships with big names like Total Energy, Dior, and strong ties into French professional networks, like accountants via Tex and St. France. That access and trust is valuable.
Okay, so what's the strategic play here for Quadient buying them?
Several things. One, they now own the proprietary software. It's their tech, giving them more control than just partnering.
Right, control and autonomy.
Exactly. Two, Cerenzia includes a PEPL access point. PEPL is the standard used across much of Europe for e-invoicing.
So it opens up the wider European market too.
Instantly gives them access, yes. Three, it massively enhances their value proposition. They can now offer a full suite: invoicing, payments, APAR automation, all integrated, a one-stop shop.
A complete package for automating finance processes.
Right. And four, perhaps the biggest immediate win, the cross-sell potential.
Into their existing mail customer base in France.
You got it.
Right.
They have over 60,000 mail customers there. Many will have to switch to e-invoicing because of the mandate. Quadient can now walk in with a trusted integrated solution.
So it helps those mail customers transition and locks them into the Quadient ecosystem further.
Precisely. It accelerates the digital transformation for a huge chunk of their base, and that logic extends to other European clients too.
The timing seems critical then, getting this done well ahead of the 2026 mandate.
Absolutely. And they mentioned integration should be quick, just a few months, because the tech is apparently compatible.
Did they say anything about the price or Cerenzia's financials?
They kept specifics close to the chest, citing competition, but they noted it's a small team, less than 40 people, currently loss-making. Analysts are guessing maybe a low to mid single-digit multiple of sales, relatively modest.
And the plan is full integration. Or will they sell Cerenzia standalone?
The main goal seems to be integrating it into their core platform for customers. But they did leave the door open to potentially reselling just the PDP access to other software vendors too. Offers some flexibility.
Okay, interesting. Let's shift gears then. Mail division. This was the segment dragging down the Q1 numbers, right? Hardware sales down quite a bit.
That's right. Hardware was down 15.8%. And they were pretty clear on the main reason, linking back to our earlier point.
The COVID echo effect.
Exactly. Fewer placements 5 years ago during the pandemic means fewer contracts hitting their 5-year renewal window in Q1 2025. That directly impacts hardware sales opportunities.
So a direct consequence of that trough in placements back then.
Correct. And they said this cycle dip was made worse by a tough comparison to Q1 last year, which had some specific boosts, plus that ongoing macro uncertainty in the U.S. making some customers pause.
Makes sense. Were there any glimmers of hope within mail despite the headwinds?
They stressed they believe they're still outperforming the market overall. And commercial activity wasn't dead. They saw double-digit growth in cross-selling lockers to mail customers.
Okay, so leveraging that base.
Yes, and digital order intake coming via the mail sales channel was up 50%. That's significant. Shows the mail relationship is still a valuable conduit.
And what about the profitability in mail?
It actually ticked up slightly. The EBITDA margin improved a bit, which they put down to benefits from earlier integration and cost efforts.
Any other notable developments? Wins.
A big one strategically was getting FedRAMP authorization in the U.S.
Ah, the government security standard.
Right. That opens up the U.S. federal agency market significantly, which is a big deal, and boosts their credibility as a trusted provider. They also gave an example, the University of Pittsburgh.
What was that?
They were already using Quadient Lockers, and they expanded the relationship to include mailroom management solutions too. Another cross-sell example.
Okay, and just to be crystal clear, the mail decline isn't really about customers ditching them.
That's what they emphasized. The consolidation rate customers leaving is stable. It's purely about the timing of renewal opportunities in the pipeline, or lack thereof, in Q1, not fundamental customer loss.
Got it. Okay, on to the local business then, the lockers. This looked like the standout performer.
It really was. Huge reporting growth of 35.4%. Revenue jumped from 20 million to 27 million year over year.
Wow. And how much of that was organic versus acquisitions?
Organic growth was a strong 12.2%, and there's about 4 million benefit from prior acquisitions rolling in.
And what's powering that organic growth? Subscriptions. Hardware.
Both, actually. Subscription revenue up 11.4%, and hardware sales also strong, up 12.7%.
And where is this happening?
Fueled by more usage in the UK and France, and also getting better monetization, more revenue per locker or per parcel in the US.
The UK seems to be on fire for them.
It's an incredible growth story there. The install base is now around 26,100 lockers, and they shared some pretty eye-popping numbers.
Oh, yeah.
Over the last 15 months, the UK open network size nearly quadrupled, and parcel volume through that network multiplied by 11 times.
11 times. That's massive. How?
Partnerships, directly linked to strategic deals. They extended their partnership with Evri, the big UK carrier.
Okay, what does that involve?
Expanded access for Evri, plus adding returns consolidation using the lockers, making it easier for people to return online purchases. They also signed a new deal with Stasher.
Luggage storage.
Yeah, using the lockers for short-term luggage storage. Both deals are expected to drive even more volume.
What about utilization? Are these lockers actually full?
They don't give out a specific percentage, like per bay. But they did say overall network usage is climbing dramatically, almost 100% growth quarter over quarter for 6 quarters straight.
So usage is definitely ramping up.
Massively. It doesn't mean every single locker is full all the time, but they manage it by location. If one spot gets busy, they look at adding more capacity or finding another nearby spot.
Any action outside the core markets? International.
Q1 hardware sales did include a one-off international placement. And looking forward, they've signed another significant international hardware deal, around $5 million for a few hundred lockers. That revenue should hit in the second half of 2025.
And profitability on these lockers, especially with deals like Evri driving volume.
They indicated it's very positive. More volume really helps leverage the fixed costs of running the network. So deals like Evri's are good for the bottom line.
Okay, so zooming back out then, Q1 had that expected organic revenue dip because of mail.
Right, the cyclical low point.
But underneath, digital and especially lockers are powering ahead, driving strong recurring revenue growth.
Exactly. And that recurring revenue piece is now 75% of their total revenue, up from 72% last year. That provides a really solid foundation.
Which explains why management feels confident enough to stick with their full year 2025 guidance. They're still expecting acceleration.
That's the message. They expect both organic revenue growth and organic EBIT growth to accelerate compared to last year.
And what gives them that confidence?
A few things. The good start on profitability, with those improved EBITDA margins everywhere. The expectation that mail will recover in the second half as renewal opportunities pick up.
Right, the cycle turning.
Exactly. Plus continued momentum expected in digital and lockers, improving profitability there too. And they mentioned a promising order pipeline across the board.
Okay. Anything else noteworthy? Shareholder changes? Macro impacts?
Yeah, they mentioned a Swiss hedge fund, TOS, dropped below the 5% ownership level. But more significantly, the largest shareholder, linked to Daniel Katinsky, upped their stake quite a bit.
Oh, really? From what to what?
From about 16.5% to 22.6% between end of Jan and start of April. That usually signals strong long-term belief in the company.
Interesting. And what about those U.S. tariffs we hear about? Any impact?
They downplayed it, said the direct hit is pretty small right now, maybe a couple of million euros. The tariffs are around 10%, currently paused for 90 days anyway.
And their response?
They immediately put up prices on their U.S. hardware mail machines, lockers, to fully offset the cost. They also mentioned a UK facility helps due to a free trade deal. Seems they feel they have the pricing power.
Okay, so the overall story is planned Q1 dip, underlying strength in growth areas, strategic moves like Cerenzia setting them up, and confidence in a second half acceleration.
That sums it up pretty well. They also frame themselves as a potential industry consolidator, but importantly said they don't need M&A to hit their current targets. They'll just be opportunistic if the right deal comes along, like Cerenzia apparently did.
All right, which brings us inevitably to the part where we look ahead and get a bit speculative.
Indeed. Time for our This Is Not Financial Advice segment.
Okay, based purely on everything we've just discussed from the call, here's an outrageous but plausible trade idea for you to consider. Go long Quadient.
Okay, lay out the thesis.
The bet is on a convergence of factors. First, that mail business does see its cyclical recovery kick in strongly in the second half, providing a significant lift. Second, that the incredible momentum in the UK locker network continues, maybe even accelerates, with monetization really ramping up. And third, the Cerenzia acquisition acts as a major catalyst, perfectly positioning them to capture the mandatory French E-invoicing wave. It's a multi-engine growth story kicking into high gear.
Okay, I see the narrative. Now, what makes that outrageous?
Well, the outrageous part is you're putting quite a bit of faith in that mail turnaround. Legacy businesses can be tricky. What if the macro environment stays tough and delays those renewals further? Good point.
There's also execution risk. Integrating Cerenzia quickly while capitalizing on the French opportunity and trying to replicate the UK locker success elsewhere, that's a lot to juggle. Things could slip. International locker expansion hasn't always been smooth sailing historically for players in this space.
Fair points. So what makes it plausible then?
The plausibility comes from management's apparent conviction about that mail cycle, based on tangible contract timing from 5 years ago. It's not just hope, it's based on historical data.
Okay.
Then you have the locker metrics in the UK. Quadrupled network, 11x volume growth, near 100% quarterly usage growth. Those numbers are hard to ignore. They show something is working incredibly well there.
Right. The traction is undeniable.
And Cerenzia. The strategic fit is clear. The regulatory driver in France is real and unavoidable for businesses, and the cross-sell opportunity into that massive mail base is genuinely significant. Plus, they've shown they can manage costs and push through price increases for things like tariffs, so the pieces could align for that acceleration.
So a potential confluence of a cyclical upswing, secular growth, and strategic execution.
That's the bull case in a nutshell. And as you chew on that, here's a final thought to mull over.
Go on.
Think about those 60,000 plus French mail customers. Right now, many are probably just starting to figure out this whole mandatory E-invoicing thing. How effectively can Quadient leverage those existing relationships, that existing trust, to convert them onto the Cerenzia platform? Could that cross-sell engine fire up even faster and bigger than expected, becoming a really dominant near-term driver? Something to consider.
Definitely food for thought. And just to reiterate one last time, this has been our deep dive based on the information from Quadient's earnings call. It is absolutely not financial advice. Please do your own homework and speak to a qualified professional before making any investment decisions.
Absolutely. Do your own research.
Thanks for taking the deep dive with us today.